Most traders believe overtrading is a discipline problem, that if you just had a little more willpower, a little more control, you'd stop clicking the buy button when you shouldn't. That belief is wrong, and it's costing you money right now. Overtrading isn't a failure of discipline. It's what happens when the part of you that built every other success in your life, the part that pushes through pain, that refuses to quit, that solves problems by working harder, walks into a market that punishes exactly that instinct. The very trait that got you promoted, got you through school, got you through a hard marriage or a hard year, is the trait quietly liquidating your account. By the end of this video, you'll understand the specific moment overtrading actually begins, why your best qualities are working against you, and what to replace push harder with so it stops happening. This isn't motivation. It's a mechanism. Let's get into it. There's a version of trading advice you've heard 100 times, and it usually sounds like this: find your edge, trust your edge, execute your edge. It's not wrong, exactly, but it skips the part that actually determines whether you survive long enough to use that edge, which is whether your edge is even built on who you are. Most traders adopt a strategy the way they'd adopt a diet plan someone else swears by. They copy the entry rules, copy the risk parameters, copy the time frame, and then wonder why they can't stick to any of it under pressure. The reason is simple, and almost nobody says it out loud. A strategy that fights your nature will lose to your nature every time the pressure gets high enough. You can have a mathematically sound system on paper and still fail to execute it, not because the math was wrong, but because the human being sitting in front of the screen was never built to run that particular process, and no amount of backtesting fixes a personality mismatch. Think about the traits you already have, the ones that show up whether you're trading or not. Maybe you're naturally impatient, quick to decide, energized by fast feedback, the kind of person who'd rather know now than know eventually, who gets restless in long meetings, who finishes other people's sentences not out of rudeness, but because your mind has already moved 3 steps ahead. Or maybe you're the opposite, methodical. You like to sit with a problem, turn it over, look at it from 6 angles before committing to anything, the kind of person friends ask to review contracts because you'll actually read the fine print. Neither of these is better, but they are radically different operating systems, and the market has strategies that reward each of them and punish the other. Put the fast, feedback-hungry personality into a slow swing trading system built around multi-day holds, and you will watch that person slowly go insane. They'll check the position 40 times a day. They'll exit early just to feel the relief of a closed trade. They'll add unnecessary indicators to the chart just to feel like they're doing something, anything, while the position does what it's supposed to do, which is nothing dramatic for another 2 days. Not because the strategy was bad, because the strategy was a mismatch. Now put the patient, methodical personality into 5-second scalping. They'll freeze. They'll hesitate at the exact moment hesitation is fatal, because their nature wants more information, and scalping never gives you more information in time. They'll get chopped up not because they lack skill, but because the time frame is asking them to become a different person in real time, and nobody can do that convincingly under financial pressure. This is the signature strength mirror, and it means your job isn't to find the best strategy in some abstract sense. There is no universally best strategy. There's only the strategy that is the best expression of traits you already have, ideally traits you've already proven you have in some other part of your life. If you've built a business, you likely already have a tolerance for uncertainty and an instinct for weighing risk against reward under incomplete information. That translates almost directly into active investing or swing trading, where the skill is patience, while a thesis plays out over days or weeks. If you've competed in a sport that rewards split-second reaction, boxing, tennis, anything with a short decision window and immediate physical consequence for hesitation, you likely already have the reflexes and the comfort with instant feedback that scalping demands. If your gift has always been reading people, negotiating, sensing when someone is bluffing across a table, that same instinct for reading intention translates surprisingly well into reading order flow and market sentiment, because both are ultimately exercises in reading what other people are about to do before they've fully decided to do it. You are not starting from zero when you choose a trading style. You are choosing whether to draw on 20 years of instinct you already trust, honed in rooms that had nothing to do with candlesticks, or throw all of that away and start pretending to be a different person with a spreadsheet and a strategy PDF you downloaded from someone whose life looks nothing like yours. Consider someone who has spent a career teaching, a coach, a professor, a manager who trains junior staff. That person has built a deep, practiced instinct for breaking complicated systems down into their component parts and explaining them clearly, for spotting exactly where a student is confused before the student can articulate it themselves. That instinct doesn't disappear the moment they open a trading platform. It shows up as an unusual strength for macro analysis, for understanding how one part of the market structure feeds into another, for teaching themselves a system methodically instead of chasing shortcuts. Meanwhile, someone who has spent years in high-pressure sales, reading a room in real time, sensing hesitation before a client voices it, adjusting their pitch mid-sentence based on a shift in body language, that person often has an unusually good feel for short-term sentiment shifts, the kind of read that shows up on a 5-minute chart as price starting to hesitate before it reverses. Neither of these people needs to become someone else to succeed in markets. They need a style that lets them be more of who they already are, not less. Here's the practical version of this. Take an honest inventory, not of your trading results, of your life results. Where have you actually won, consistently, outside of markets? What was the trait underneath those wins? Curiosity that made you dig deeper than everyone else in a meeting, that made you the person who actually reads the footnotes. Self-control that let you wait when others acted, the kind of restraint that got you through a long negotiation others walked away from too early. An entrepreneurial instinct for spotting undervalued opportunity before anyone else noticed it, the kind of pattern recognition that made you buy the right neighborhood, or the right domain name, or the right small stock, years before it was obvious. Whatever that trait is, that's the trait your trading style needs to be built around. If you're currently trading a style that requires the opposite of your signature strength, if you're a naturally patient person, forcing yourself into fast scalps because a YouTube video told you that's where the money is, or a naturally quick, decisive person, forcing yourself to sit on multi-day swing trades because someone convinced you that's the serious way to trade, that mismatch is very possibly the single biggest thing standing between you and consistency. Bigger than your entry criteria, bigger than your risk-reward ratio, bigger than any indicator you could add to the chart. You cannot optimize your way out of fighting your own nature every single session. Now, even with the right style, matched to the right personality, you're still going to have moments where your own head turns against you. Nobody escapes this entirely, no matter how well matched their strategy is. This is where most traders reach for journaling, and journaling is fine as a long-term practice, but it's often too polite, too slow, too after the fact to actually work in the moment it's needed. When a self-sabotaging thought shows up in the middle of a session, you always do this, you're never going to be consistent, you just proved you can't be trusted with size. This is exactly what happened last month and you didn't learn anything. Writing it down calmly in a notebook after the session ends doesn't do much for the version of you standing in the fire right now, in that exact minute, hand hovering over the mouse. What actually works, and it sounds almost too simple to be a technique, is confrontation with heat behind it. When that voice shows up, you don't negotiate with it, and you don't journal it politely later. You treat it like it's coming from someone external, someone you don't respect, someone who does not get to run your account, and you tell it, internally, in no uncertain terms, to get out. Not gently, with enough emotional charge that it actually interrupts the spiral instead of feeding it, the same way a sharp, sudden noise can snap you out of a daydream, in a way a quiet reminder never could. This works because rational arguments rarely beat emotional momentum in real time. If you're already spiraling, let's think about this logically. Doesn't have enough force to break the pattern. You already know the logic. That's not the problem. The problem is that logic has been temporarily outvoted by feeling. But a jolt of genuine anger, directed at the sabotaging voice, not at yourself, not at the market, not at the trade that just stopped out, does have enough force. It's a pattern interrupt, the psychological equivalent of physically standing up and walking away from a table you were about to make a bad decision at. You're not trying to become a calmer, gentler version of yourself in that exact second. That version takes longer to build, and this moment doesn't have time for it. You're trying to survive the next 90 seconds without doing something catastrophic. And sometimes the fastest way out of a bad mental loop is a hard, decisive rejection of it, not a soft one. Traders who try to talk themselves down gently in the heat of a bad moment often lose that argument, because the sabotaging voice is louder and more urgent than a calm internal reminder. You need something loud enough to actually compete with it. Picture the moment right after a stop-out that shouldn't have happened, the one where you can already feel the next sentence forming in your head. Something like, "You always find a way to ruin a good week," or "You're not actually cut out for this." Left unanswered, that sentence doesn't just sit there. It becomes the lens for the next decision, and the next, quietly justifying a revenge trade because some part of you has already decided the sentence is true and wants to disprove it in the next 20 minutes instead of the next 20 days. The interruption has to happen before that sentence finishes forming, not after you've already acted on it. That's the entire function of meeting it with force in the moment. Not politeness, not later analysis, but an immediate, decisive rejection, loud enough to stop the sentence from writing itself all the way to the end. If any of this is landing, and you can feel a version of your own pattern in what's being described here, take 15 seconds, hit subscribe, and turn on notifications. This channel exists to keep mapping exactly this kind of thing, the psychological mechanics nobody else in trading education actually explains clearly, and you'll want to be here for what's coming next. Once you've survived the moment, there's a second habit that determines whether you actually improve or just tread water, and it's the opposite instinct of what most traders do at the end of a session. Most traders review their day by hunting for mistakes. What did I do wrong? Where did I break my rules? What cost me money? This feels responsible. It feels like accountability. It even feels, in a strange way, like humility, the mark of someone serious enough to be hard on themselves. But run that process every single day for a year, and you will build a trader who is excellent at self-criticism and terrible at confidence. Because you have spent 300 sessions training your brain to notice only the wreckage, to treat every day as a search for what went wrong, and a mind trained that way starts to see danger everywhere, including in setups that were actually fine. Confidence isn't built by avoiding mistakes, and it isn't built by punishing yourself thoroughly enough for the ones you make. It's built by having verifiable proof, in your own handwriting, accumulated over time, that you are capable of doing the right thing under pressure, on command, even when the outcome doesn't cooperate. So flip it. At the end of every session, win or lose, find one thing you did correctly and write it down specifically. Not, "I traded fine today." That's not specific enough to mean anything. It's the trading equivalent of telling a child "good job" without saying what they did well, and it teaches your brain nothing repeatable, something concrete. I sized down after the first stop instead of revenge sizing up. I waited for the confirmation candle instead of anticipating it, even though the anticipated version would have worked out fine this one time. I closed the platform at my time limit even though a setup was forming that I genuinely believe would have worked. That single sentence, repeated daily, becomes a compounding record of evidence that you can trust yourself, a private archive you can return to on the days your confidence is shakiest. And on the days where the outcome was still a loss, because outcome and process are not the same thing, and you already know that intellectually even when it doesn't feel true in the moment, this practice is what stops a losing day from becoming a losing identity. You are teaching yourself to be your own mentor, the kind who notices growth instead of only cataloging failure. Because nobody else is going to sit next to you at 6 in the morning and do it for you. No mentor, no course, no community is going to be there in that specific 90 seconds after a stop-out to remind you what you're actually capable of. That job belongs to the record you've built for yourself, and if that record only contains failures, it will only ever tell you a story about failure. None of this becomes real, though, until it survives contact with time. A single good decision on a single good day proves almost nothing. Anyone can execute cleanly once, on a lucky day, when conditions cooperated and nothing tested them. What proves something is repetition long enough that the behavior stops requiring willpower at all, long enough that it moves from something you have to consciously choose into something you simply do, the way an experienced driver doesn't consciously decide to check a mirror before changing lanes anymore. This is where most process improvement efforts quietly die. The trader identifies the right fix, applies it for 4 or 5 days, feels great about the progress, sees the market throw something unrelated at them on day 6, and abandons the fix before it ever had a chance to become automatic. Then, weeks later, they identify the same fix again, as though for the first time, and the cycle repeats. 90 days is not an arbitrary number pulled from a self-help book. It's roughly the window where a deliberate, effortful behavior, the kind that currently requires you to consciously remind yourself every single time, the kind that still feels like a rule you're following rather than a thing you simply are, starts to become the default behavior, the one you do without having to talk yourself into it, the one that survives a bad week instead of getting sacrificed the first time it's inconvenient. Pick exactly one thing, not 5 things, not a whole new trading philosophy, not a complete personality overhaul starting Monday. 1. Maybe it's position sizing, never increasing size after a loss, no matter how good the next setup looks. Maybe it's your exit process, scaling out in stages instead of closing everything at once out of fear. Maybe it's simply honoring your maximum loss per day rule without negotiating with yourself in the moment, without the little internal lawyer who shows up right when you're down 2 stops, arguing that this particular day is different. Whatever it is, track it daily for 90 consecutive days. In writing, with a simple pass or fail for that single behavior. Nothing more elaborate than that, because elaborate systems are themselves a way of avoiding the actual work. You will break the streak. That's expected, not a disqualification, and it doesn't mean you've failed at this. Restart the count and keep going, the same way you'd restart a workout streak after getting sick, without treating the interruption as proof the whole project was doomed. What you're building isn't a perfect record. You're building a nervous system that no longer treats the correct behavior as a struggle, because struggle is expensive, and expensive things get abandoned the moment conditions get hard. Automatic things survive hard conditions. That's the entire point of the 90 days. Not moral improvement, not becoming a better person in some abstract sense, just moving one specific skill from the effortful column into the automatic column, where it can survive the exact days it's needed most. There's one more piece of this that has almost nothing to do with your screen and everything to do with the rest of your life, and it might be the most overlooked variable in whether a trader lasts more than a couple of years. If trading is the only place in your life generating meaning, status, or emotional payoff, every single trade inherits weight it should never have to carry. A losing trade doesn't just cost you money, it threatens the only source of self-worth you've built, which means your brain will fight to avoid that threat by any means necessary, including means that make your trading worse, like refusing to take a stop, because taking the stop means admitting the loss, and admitting the loss means admitting something about yourself you don't want to admit. That's an enormous, unfair burden to put on a single position, and it guarantees you'll manage that position emotionally instead of mechanically, because the position has stopped being just a position. The traders who last tend to have built a life outside the platform that is genuinely competing for their attention and their sense of identity, a relationship they invest in on purpose, a physical practice that has nothing to do with markets, a hobby with its own internal reward system that doesn't care what the S&P did today. This isn't about balance as a soft wellness idea you'd find on a productivity poster. It's a practical risk management strategy, as concrete as position sizing. A trader who has other sources of meaning can lose a trade and feel it, genuinely feel it, without needing the next trade to fix it. That difference, needing the next trade versus simply wanting it, is very often the entire gap between a controlled loss and a blown account. And it's a gap that has nothing to do with strategy and everything to do with how much of your identity is currently sitting inside a single open position. It's worth being honest about how this actually shows up day to day, because it rarely announces itself directly. It looks like checking the account balance during dinner with people who deserve your full attention. It looks like a bad session bleeding into a bad mood that has nothing to do with anyone at that dinner table but affects them anyway. It looks like turning down plans on a weekday evening because the market might do something interesting overnight, even though nothing about your strategy actually requires you to be watching. None of these moments feel like a crisis individually. Stacked over months, they quietly narrow a person's entire life down to one input, and a life narrowed that far has no shock absorbers left for the inevitable losing streak. The practical version of this is almost embarrassingly simple. Put non-trading commitments on your calendar with the same seriousness you put your trading session on it. Training, time with people who matter to you, whatever genuinely recharges you and has nothing to do with a chart. If it's not scheduled, it quietly gets sacrificed the first time the market gets interesting. The first time a setup you don't want to miss lines up right when you were supposed to leave for the gym, and then you've accidentally rebuilt the exact one-dimensional identity that makes every loss feel existential, one skipped commitment at a time, without ever consciously deciding to do it. And finally, there's a myth in trading that deserves to be retired, which is the image of the lone genius trader, alone in a dark room lit by monitors, outthinking the market by pure isolated brilliance, answerable to no one, needing no one. Almost no durable performance in any high-skill field actually happens that way, and trading is not the exception it likes to pretend it is. Surgeons train under other surgeons for years before they're allowed to operate alone, and even afterward, difficult cases get reviewed by colleagues. Elite athletes have coaches, training partners, film sessions where mistakes get dissected by more than one set of eyes, because the athlete themselves is too close to their own habits to see all of them clearly. Musicians who reach the top spend years in rooms with other serious musicians, absorbing in months what would take a decade to discover alone through trial and error. Trading is one of the only serious pursuits where people still expect to reach mastery entirely by themselves, refreshing charts in silence, reading books alone, watching videos alone, and then wonder why their blind spots stay blind for years despite genuine effort and genuine intelligence. You don't need a physical trading floor to fix this, and you don't need to hand your strategy over to anyone. A small group, 3 or 4 serious traders, reviewing each other's sessions honestly, being willing to say the uncomfortable thing when a pattern shows up, sharing what's actually working in current conditions instead of what worked 6 months ago, compresses years of trial and error into months. Someone else will see the pattern in your losses that you're too close to see in yourself. The same way it's easier to spot a friend's blind spot in a relationship than your own. You'll return the favor for them. This isn't about copying each other's trades or forming a signal group. It's about building a feedback loop that a single isolated person structurally cannot build alone, because you cannot be objective about your own blind spots by definition. That's what makes them blind spots in the first place, and no amount of self-reflection substitutes for a second set of eyes that isn't emotionally invested in your account. None of these 6 things, matching your style to your nature, interrupting the sabotaging voice with real force instead of polite journaling, hunting for what you did right instead of only what you did wrong, committing to one change for 90 real days, building a life that doesn't need trading to feel meaningful, and refusing to do this in total isolation, none of them are complicated to understand. You could explain any one of them to a beginner in 30 seconds, and they'd nod and say, "That makes sense." The difficulty was never in the understanding. It's in doing the unglamorous version of each one, on the exact day you don't feel like it. The day the market is chaotic and your discipline feels like the least important thing in the room, which is the only day it actually counts. That gap between understanding a fix intellectually and actually installing it under real pressure is where almost every trader's real story gets written. And it's exactly where we're headed next. Knowing all 6 of these won't save you on its own. What actually separates the traders who change from the ones who don't comes down to something much smaller than any of this, and much harder to admit. You came into this expecting another lecture about discipline, about needing more willpower, more control, more grit to finally stop overtrading, another version of the same advice you've heard from every trading account on the internet. What you actually walked away with is something quieter and more useful. Overtrading was never a willpower problem. It was a mismatch between the style you were trading and who you actually are, built by copying someone else's system instead of building from your own strengths. A mismatch between how you talk to yourself under pressure and what that moment actually requires. Relying on gentle reminders when the moment called for something with real force behind it. A mismatch between measuring your progress by outcomes alone instead of by what you did well, which quietly trained you to notice only your failures. Fix the mismatch, and the discipline you thought you were missing mostly stops being necessary, because you're no longer fighting your own nature to hold it together, session after session, year after year. 5 things are worth sitting with after this video ends. Trade a style built around your actual strengths, not someone else's, not the strategy that worked for a stranger on the internet whose life looks nothing like yours. Meet the sabotaging voice with real force instead of quiet journaling, because a whisper doesn't win against a scream in the moment it matters. Track what you did right as seriously as what you did wrong, so the record you're building actually reflects the trader you're becoming and not just the trader you're afraid of being. Give one change 90 real days before judging it, because 4 days was never going to be enough for anything to become automatic. And build a life outside the platform substantial enough that no single trade has to carry your sense of self-worth, because a trade should only ever be a trade. None of this needs to be acted on today. It needs to be true the next time you're sitting in front of a losing position, deciding what kind of trader you're going to be in that moment. Most of what's covered on this channel builds on itself. The process tracking approach mentioned earlier connects directly to a few other videos already sitting in the description, and future ones will keep extending it. Rather than trying to remember all of it, the simplest move is to subscribe so the next piece shows up when it's relevant, and check the description now for what's already there. It's less about following along and more about having the reference ready the next time a session like the one described here shows up in your own trading.